Welcome to the presentation on financial valuation. This is video 4. In the previous video, video 3, we described the mathematical setting, a very simple mathematical setting, a probability space in a single period world. And this will be used in this and the coming videos of this financial valuation presentation to illustrate insurance securitization by very simple examples. Let us start with an example on pandemic risk. We have a financial world, a financial actuarial world with two traded assets. The traded assets are a traded zero coupon bond, a traded stock, and then there is a third claim, a non-traded pandemic index. The traded zero coupon bond has current price Y0 is 1, and its price at time 1, Y0 is also 1. So we assume an interest rate R equal to 0 just for notational and computational convenience. The traded stock has current price 100 and its price at time 1 is random but can only take two values, 50 or 150. Then there is also a pandemic index, but this index is not traded in this part of the exercise. I is 0 or 1, 0 in case no pandemic break out in the coming year in period 0-1, let's say, is 1 if there is a pandemic break out in the coming year. We will model this world with a probability space, omega 2 to the power omega p. Omega is the universe, 2 to the power omega is the set of all events, and p is the physical probability measure. Omega is the universe, is all the states of the world at the end of the year. This can be described by 4 couples in our simple example, 50, 0, 51, 150, 0, and 151, where each couple is a possible outcome of the random couple Y1I. So 50, 0 is the outcome in case the stock will go down to value 50 and the index will go down to value 0, which means there is no pandemic breakout. There are real-world probabilities related to each of the possible states of the world at the end of the year. For instance, P50 is the probability that the stock will have value 50 and there will be no pandemic outbreak. We will denote this by P50. And same notation for the probabilities related to all other possible states of the world. Very important now is we assume that all these probabilities are strictly positive. This will have a consequence on the characterization of the equivalent martingale measures as we have seen in the previous video. We assume that Y1 and I are P-dependent. What do I mean with P-dependent? It means that they are not independent. So there is some dependence between the stock and the pandemic. Let us first have a look at the no-arbitrage condition. No-arbitrage if there exists an equivalent martingale measure. So that means there exists a probability measure Q equivalent with P satisfying the no-arbitrage conditions, satisfying the martingale conditions. The current price of each of the traded assets is equal to the discounted expectation of the payoff at time 1, discounted with the interest rate R, which is equal to 0. So we have to check whether there is no arbitrage by checking if there exists an equivalent martingale measure satisfying this condition. Well, we will do that and we will come up with, we will rewrite this no arbitrage condition in the following way. There must exist positive probabilities Q50, Q100, Q51, Q150, and Q151, satisfying these conditions, Q50 dot and Q150 dot, must both equal to 0.5. Let us try to prove that. Well, so the no arbitrage condition is rewritten here. There exists a Q equivalent to P satisfying these two conditions. So Q is characterized by the Q50, Q51, Q51, Q150, and Q151, and they all have to be non-negative, and they have to add to 1 such that this first condition here, expectation under Q of Y0 is 1, can be rewritten as the sum of all the probabilities is 1. The second condition is the expectation under Q of Y1 must be 100. So Q50 plus Q51, that's the probability under the equivalent martingale measure that the stock will go to value 50, multiplied by the value 50, plus the probability under Q that the stock will go to value 150, multiplied by its value 150, must be equal to 100. The Q must be equivalent, and we have seen, because all the P's are strictly positive, the equivalence here will mean that all this Q50, Q51, Q150, and Q151 have to be strictly 0. So this is the set of equations that we have to solve, or we have to look if there exists Q's satisfying these conditions. We can rewrite this a little bit in the following way. There exists Q50, there exists Q50 and other probabilities larger than 0 with, and then we take Q50 plus Q51 is Q50 is Q50 dot, Q150 plus Q151 is Q150 dot. This must be equal to 1, and we can also rewrite the second condition here in this condition. Okay. Then this can be rewritten as there exists this Q's, there exists this Q's here with, we rewrite now these two sets of equations, this set of equations in this set, and we can do that by taking here row 2 minus 50 times row 1. Then we get this issue. Going further, we find then that we can rewrite this in the following way. There exists Q50 larger than 0 and all the other Q's also larger than 0, such that Q50 dot is 0.5 and Q150 dot is also 0.5. So, in fact, we have indeed proven that in this simple setting with two traded assets, the only thing we have to find, or all the equivalent martingale measures have to satisfy these conditions. They have to be strictly positive values, and only the projections on the financial market are fixed. There is no any condition on the actuarial projection. The reason for that is there is only financial asset, namely the stock traded, and not the pandemic index. It's not traded. That's the reason. Now, there are two particular solutions of this set of possible equivalent martingale measures, which we will denote by Q star and Q orthogonal. Q star is defined here, and just easy, it is easy for you to verify that this indeed satisfies the martingale conditions. And then there is another Q orthogonal, which we define as follows. We take the projections of the Q star and we multiply them so that we come in the independent setting. So if we do this, if you do this calculations, you will find here the values 0.35, 0.35, 0.15, and 0.15. So we have found at least there are at least two equivalent martingale measures. In fact, there are an infinite number. We just have illustrated here two examples. So the market of traded assets is arbitrage free because there exists equivalent martingale measures, but it is incomplete because there is not one, but there are more than one. The P dependency of Y1 and I, remember we assumed that under the measure P, Y1 and I show some dependence, but that does not necessarily imply Q independence of Y1 and I under any equivalent martingale measure? Indeed, it's easy to verify. You can do that. You can check that Y1 and I, or the value of the stock and the pandemic index, they are independent here under Q star, but they are not independent under, sorry, they are independent under Q orthogonal, but they are not independent under Q star. So this is an example where there is, this Q is an example where there is dependence maintained between stock and pandemic index. This is an example of a Q where there is independence. Then let us now go to a second exercise. We consider now the market of the two traded assets of example 1. We found the set of equivalent martingale measures, but we want to write them in another way. There are an infinite number, so we want to write them in a parametric way. First question is, show that the set of equivalent martingale measures is given by the set of all Q satisfied in this way. There are two parameters, Q and Q prime. This Q has to be between 0 and 1/2. This Q prime has to be between 0 and 1/2. And for any choice of this Q and Q prime, if we define all our Q probabilities in this way, we find an equivalent martingale measure. And this defines the whole set of equivalent martingale measures. Let us have a look how we can prove this. Well, we know that Q is an equivalent martingale measure if and only if these three conditions are satisfied. We have just seen that some slides ago. Let us now fix Q51. If Q51 is Q, then from Q50 dot, we find that Q50 dot must be 1/2 minus Q. And we also fix Q151. We set Q151 Q prime, then Q150, because of this condition, must be 1 minus Q prime. Now, we have rewritten these conditions here in this way, but there is still the condition that all the Q values have to be strictly positive. So Q has to be strictly positive, 1/2 minus Q has to be strictly positive, Q prime also, and also 1 minus Q prime. So that means that Q has to be between 0 and 1/2, and also Q prime has to be between 0 and 1/2. So indeed, the set of all equivalent martingale measures is given by this characterization. Then there is a second question. Let us determine the hedge and the no arbitrage price of this put option. It is a put option on the stock Y1. The plus means the maximum of 0 and 100 minus Y1. Let us determine the hedge of this put. Therefore, we go to question 2. We denote the hedge theta by theta 0, theta 1, and it will be a hedge if the final value of this trading strategy satisfies or is equal to 100 minus Y1 plus. Or we can rewrite this, theta 0 multiplied by Y0 plus theta 1 multiplied by Y1, that's the vector product, must be equal to 100 minus Y1 plus. And then we look at all possible values for Y1. This equation, when Y1 is 50, turns in this equation. And the equation here, in case Y1 is 150, turns in this equation. So we have a set of two equations in two unknowns that we have to solve. It's worked out in some detail here, but we find, in fact, that theta 0 is 75 and theta 1 is minus 0.5. So that means that theta equal to the couple 75 minus 0.5 is a hedge for the put here. So we buy 75 units of the zero coupon bond and we sell 1/2 unit of the stock, and this will perfectly hedge our put. We have a hedge for the put, so the price of The put is nothing else than the price of the hedge, theta multiplied by y. And if we work this out, we get this value here. Okay. Then we come to the third question. The third question asks us, determine the set of admissible no arbitrage prices of the pandemic index I. The pandemic index is not hedgeable, but what are all admissible no arbitrage prices? And also of this, in fact, exotic option. This is an exotic option, 100 minus y1 plus multiplied by I is an exotic option that looks as follows. It is equal to 50 when, if y1 is 50 and I is 1, while it will be equal to 0 in the other case. So this is a kind of exotic option that only if the stock goes down and there is a pandemic outbreak, there is a payment of 50. Well, let us determine the set of admissible prices. If we bring this pandemic index to the financial market, what would be a possible price? That's the question, in fact, that we want to answer. Well, then therefore we go to question 3. The set of admissible prices, first of all, of the pandemic index is given, as we have seen before, by rho qi, where q is an equivalent martingale measure. What is now rho qi? We have characterized the set of all equivalent martingale measures. So rho qi is e to the power minus r, the expectation under q of y, or the expectation under q of y is in fact nothing else than q dot 1, the probability that the pandemic index goes to 1. What is now q dot 1? That's q51 plus q151. And now we know that q51 is q and q151 is q prime for some q between 0 and 1/2 and for some q prime between 0 and 1/2. So the price of the pandemic index is q plus q prime with q and q prime satisfying these conditions. So that means it's an element of 0, 1. So any possible outcome between 0 and 1, 0 and 1 not included, is a possible price for the index. A little bit similar but more complicated is, let us have a look at the set of admissible prices for this exotic option, 100 minus y1 plus multiplied by I. Again, this is given by rho q of the payoff over all q measures. What is rho q of this payoff? Is the discounted expectation of the payoff. R is equal to 0, and this expectation is the probability under q that we are in the state 51 multiplied by 50, because in all the other cases the payoff is 0. Q51, this is for all equivalent martingale measures as we have characterized, equals to 50 times q for some q between 0 and 1/2. So that means that the set of admissible prices for this exotic option here must just be an element, it must be an element of 0.025. Any possible value between 0 and 25 is okay as a price for this exotic option if we bring it to the financial market. So the price can be very low or can be relatively high, cannot be 0, because if the price would be 0, there would of course be an arbitrage opportunity. Now we come to the following. We consider now, we go now to example 1 prime, where we consider a world with 3 traded assets. So we look at the same example as example 1, but we add 1 traded asset. So we consider a world which is home to a traded zero coupon bond, a traded stock as before, and also now there is a pandemic bond. The traded zero coupon bond has current price 1 and price at time 1. The traded stock, as we know already, has price 100 and its price at time 1 its value at time 1 will be 50 or 150. And now the traded zero coupon pandemic bond has a current price of 70, and its payoff at time 1 is 100 multiplied by 1 minus I, where I is the pandemic index. What does that mean? If there is no pandemic breakout, I is 0, and then the payoff is 100. If there is a pandemic breakout, the payoff is 100. So indeed, we have a pandemic bond that, in case of a pandemic breaks out, the final payment of 100, the principal, is completely eaten. Again, as before, we model this world in the same probability space as before with the same universe, and the probabilities are the same as before. We don't have to characterize them, but we know that they are strictly positive, and as before, y1 and I are assumed to be P independent, to be P dependent. Let us now check if there is no arbitrage possible in this market. What is the no arbitrage condition? The no arbitrage condition tells us there is no arbitrage if there exists a Q equivalent to P satisfying these conditions. The expectations under Q of each of the traded assets must be equal to their respective prices. Usually it should be discounted expectations, but R is 0, so we can delete it here. Now we can rewrite the no arbitrage condition in the following way. There exists positive Q values satisfying Q50 dot and Q150 dot both have to be 0.5, Q.0 and Q.1 have to be 0.7 and 0.3 respectively. So we see here now the stock is traded and the pandemic bond is traded, and that means that in our characterization of the equivalent martingale measures, the projection of the financial projection is fixed, and also the actuarial projection is fixed. How can you prove, or how can you rewrite 3 in this form? This is shown on the following slide. So you can see this here. Here I worked out this problem. You can have a look at it by yourself. Now, we can also write the set of equivalent martingale measures, similar as what we did before, in a parametric way. So the set, if we have the 3 traded assets, the set of equivalent martingale measures is now characterized by these values of the Q's with one parameter Q, and Q can have a value between 0 and 0.3. Just try to prove this by yourself. Well, this condition Q between 0 and 0.3 comes from the fact that all these Q values here, Q50, 0, and so on, they all have to be larger than 0. Okay. The 2 particular equivalent martingale measures that we defined above, Q star and Q orthogonal, are both solutions of this set of equations. You can easily verify this by yourself. So again, we know here that our market of traded assets is arbitrage free because there exists equivalent martingale measures, but incomplete because there exists more than one. This was also expected because we only have a condition on the valuation of on the value of the stock and of the value of the bond or the pandemic index, but we do not have any condition. There is nothing traded that combines the two. So the dependence between the two is not traded, so to say. Q orthogonal now is the unique equivalent martingale measure under which Y1 and I are independent. Why is that? Because the marginals are fixed. If the marginals of 2 random variables are fixed, if we look at the couple and we want independence, there is only one way that there is only one couple that satisfies given marginals and is independent. Y1 and I are Q star dependent. That's also something that we know already from before. Now we come to the third exercise. We consider the financial actuarial world as described 2 slides ago, with the zero coupon bond, the stock, and the zero coupon pandemic bond. And now what we want to show is that the payoff 100 minus y1 plus multiplied by I, so this exotic payoff that we considered also in the previous exercise, this cannot be replicated in this market. This is also to be expected because y1 is traded, and in fact also I is traded, but the combination, the dependence between the two is not traded. We have to show now that indeed it cannot be replicated, and then that means that there will be more than one price. We have to determine the set of admissible prices of this exotic option. Let's have a look here at this exercise 3. So suppose here that this, suppose here, I'll make it a little bit bigger. Suppose here that 100 minus y1 plus multiplied by I can be replicated by the trading strategy theta, this one. Then the terminal value, the time 1 value of the trading strategy must be equal to the payoff of the exotic option. And now this equation, we rewrite this for each possible outcome of the stock and the index. So there are 4 cases, 4 situations, 50, 0, 150, 0, 51, 151. If we fill in the numerical values for the stock and the pandemic index in this equation, we get this 4 sets of equations. Or we can rewrite this a little bit in the following way. I let you do this as an exercise, and in the end, if we work this out, we find in the end that theta 2 is 1 over 2, and at the same time theta 2 is 0. So we find a contradiction. So we assumed in the beginning that there is a trading strategy that hedges, that replicates this exotic option, but this is impossible because if there exists a trading strategy, the theta 2, the number of pandemic bonds to be bought has to be equal to 1 over 2 and 0 at the same time, which is of course impossible. Conclusion, 100 minus y1 plus I cannot be hedged. We cannot find a theta. Okay. What are now the admissible prices? What are the admissible prices for this exotic payoff? Well, the admissible prices, as always, are rho q of the payoff, or e to the power minus r expectation under q of the payoff. And this expectation is very simple because it's only equal to 50 if we are in the state Q51, and it is 0 in all the other cases. And this this Q51 must be equal to Q. We know that from the characterization of all equivalent martingale measures with Q some value between 0 and 0.3. So that means that the price of this exotic option must be an element between 0 and 15. Okay, so any price between 0 and 15 is a possible price. Now we come to example 1 double prime. We started with a market with 2 traded assets. We added an additional traded asset, and now we will again add another asset to make the market complete finally. So we consider the world which is home to a traded zero coupon bond, a traded stock, a traded pandemic bond, and a traded combined security. The zero coupon bond and the stock and the pandemic bond, we have seen that in example 1 prime. The traded combined security has a current price Y3. We do not specify it, it's fixed, but let's call it Y3. And its payoff at time 1 is 100 minus Y1 multiplied by I. So now we trade the stock, we trade the pandemic bond, and we also trade, in fact, the combination, the dependency structure, let's say between Y1 and I. Okay. We model this world in the probability space just as mentioned before, the same probability space with the same probabilities and notations, which are all assumed to be strictly positive. What is the no-arbitrage condition now? The no-arbitrage condition is there exists an equivalent martingale measure Q satisfying the 4 martingale conditions. Prices of the expected value under Q of the prices of the traded assets, the 4 traded assets, has to be equal to their price, to their respective prices. If we solve this, how can you solve this? The solution is mentioned here. We start with this condition. This condition can be rewritten as, we know already the first 4. There exists a Q equivalent to P satisfying 1, 2, 3, these 3 conditions can be written as there exists a Q50 0 larger than 0 and so on, satisfying this, this, this and this condition. And then there is an extra condition, namely for the combined security, this condition has to be satisfied, and this condition can be rewritten as Q51 multiplied by 50 is Y3. So this is the set of equations that we have to check if they have a positive solution. So if we work this out a little bit, we come up with this set of equations, and we can still rewrite this a little bit in the following form. Here, there exists positive Q50, Q150, Q51, and Q151, sorry, satisfying these 4 conditions. So we have solved, or we have found indeed this thing. In this financial actuarial world with 4 traded assets, the no arbitrage condition says there exists positive Q50, Q51, Q150, Q151, satisfying this. Now, is this market arbitrage free? Yes, there must exist Qs. The Qs must be strictly positive. So this here must be strictly positive, meaning that Y3 has to be smaller than 25. This must be strictly positive. This will always be satisfied. This must be strictly positive, so Y3 must be larger than 0, and this means Y3 must be smaller than 50. So if we find a Y3, if we have a price for this combined security Y3 in 0.15, then we have a unique solution to this set of equations here. So the market is arbitrage free and also complete because the solution is unique if and only if our price of the combined security is 0.15. So if we bring the combined security to the market, we can have an arbitrage-free and complete market, provided our price is between 0 and 15. So there is a huge variation. It can be almost for free, almost 0, but not 0, and it can be very high, almost 15, but not 15. Under all these conditions, there is no arbitrage, and the market is complete. Y1 and I, now, are they independent under the equivalent martingale measure Q? You can check. This can only be true if Y3 is 7.5. So if the price of the third asset of the combined asset is 7.5, then under Q, Y1 and I are independent. If Y3 is, for instance, equal to 10, there is no independence. Okay. Conclusion. In an arbitrage-free and complete market, it may happen that the pricing measure Q does not maintain the dependency between which holds under P. Indeed, if we price the combined security by 7.5, the independence under P becomes the dependence under P becomes an independence under Q. So this is the end of this video.